Good afternoon. This is Brad Dennis with BIS Commodities with your weekly afternoon update. This is for the last week of January, first day of February. To start off the week, we did have a lot of economic data out this week. We had FOMC meeting, we had unemployment data, and we had prelim GDP for fourth quarter. As far as the unemployment data that came out at 7:30 this morning, people were expecting 195,000 on the non-farm payrolls, came in at 155. But when you look back, they revised last month's 155 up to 195, so fairly neutral on the non-farm payrolls. We did see an uptick in unemployment that went from 7.8% up to 7.9%, but it's being blamed on the weather to a certain extent. And the other one was private payrolls were only up 166,000, so that was a little disappointing. And right now in the market, disappointing numbers are actually cheered because they keep an easy policy in line. Like I said, we had unemployment. We also had GDP. GDP came in for fourth quarter down 0.1%. The negatives on that was a big reduction in government spending. And a reduction in inventories. Both of those ate away at GDP, but it is concerning to have a negative GDP number, and it kind of tells you that we were limping into into the year 2013. The third economic development this week was the FOMC meeting, and with those numbers being so low on the with the GDP number and with the unemployment number going up, everybody assumed that the FOMC meeting would be announced to stay the course, and that's what they did. So that really put a hurt on the dollar this week, and that lower dollar index allowed the euro currency to break out to the upside, and that has increased some attention into the commodity markets. As for the grains, corn started off the week rallying with traders looking at a drier forecast out there. Once again, we have a GFS model, the American model, and then you have the Euro model. If you remember last year, the Euro model was a lot more accurate than the GFS or the American model for the United States. Seems to be the case this year as well down in South America. So the GFS puts in a little bit wetter conditions. The Euro takes that out. Well, they came to agreement in the Euro, or the GFS was agreeing with the Euro on a little bit drier forecast, and that ran corn up, and we were able to take out that technical level of $7.35 basis the March. Once we took that out, we did have some fund buying come in. We saw on Wednesday open interest was up 21,000. On Thursday open interest was up 25,000 in corn. So it is attracting some money out there. You know, both you're making technical achievements in corn, and you've got this lower dollar, so we have some money managers throwing some money at this corn market right now. Now, on the fundamental side, you're looking at further idling of ethanol plants. You're looking at a cattle on feed report last week that showed instead of having 104% placements, we only had 99% placements. You're looking at a cattle inventory report that came out this afternoon that said the inventory was down 2%. So you're not seeing that domestic demand that maybe we were seeing about a month ago, and that could come into play on this market. Today we did close the March corn over that 735, so definitely positive on the charts, but will fundamentals reach up with that? Remember, you do have a crop coming out of South America. We're still trying to judge how big that crop is, and maybe we're squabbling over minor bushels here, but you look at what's coming out of Brazil and you pay 75 cents under the July coming out of a Brazilian port, where we're trying to export corn out of the U.S. port at 55 cents over. the cheapest one is South America, so we're not picking up any demand in that way, and I wouldn't be surprised to see corn come into the United States during that time frame if people want to sit on what they have in the bins. In the beans, same type of story. We saw technical achievements made over there, 1461 in the March. Got over that, was able to run some stops, had open interest increase, not as substantially as corn, but still increased, and we've made a run up towards that 100-day moving average. Now today we did close over the 100-day moving average at 1476, so it looks like that'll add to the bullishness going forward. We're going to look at weather this weekend, see if the rains continue or not. And then after this weekend, we're going to be looking out to February 10th before you see the next rain event out there in Argentina. Now, on the other side of beans is the logistical issues. You've seen a lot of rain in northern and central Brazil, and that has backed up harvest. And to fulfill those contracts, they need to get those beans to the port. Well, that might not happen now, and we could see a little bit of old crop being bought up out of the Gulf there, or the PNW. If that does happen, you'll see those spreads explode again, and you'll probably see us hit that $15 mark, I would imagine. Also, when you're talking about beans, you got to talk about meal and oil. And if you look at a chart of the soybean oil of March, you've got a reverse head and shoulders that gives you a count out to about 56. So that is definitely positive over there as well. Earlier I referenced the cattle inventory. We did get cattle inventory numbers out, 2% less than what we had 2011. So the herd was down 2%. Traders were expecting it to be down 1.9%. So that's not going to be anything new for the cattle market. The cattle market did get a bump at the very beginning of the week. We gapped higher. We saw last Friday the cattle on feed report. Placements were expected to be 104%. They came in at 99%. Marketings were supposed to be 93%, came in at 98%. So bullish cattle on feed report, and it seems like the spec traders wanted to run with that. So they bought up the board, but we never saw cash follow through. On Monday, yes, they bought up the futures board and they rallied it up to $1.29 in the Febs. On Monday, our boxes for choice were running at 187.03. Today, this morning, choice box running at 183.99, $4 off of that. So it's a big disjoint between futures and where the boxes are running right now. So we'll see if that comes together. I imagine that they'll try to fill that gap early next week. So we'll see positive chart formation for corn and beans, undoubtedly. Weakness in wheat is kind of hindering the corn a little bit, but I would imagine that you'll probably continue to see a little bit of price appreciation out there next week. I don't think that this inventory report was enough to boost up the cattle, or the demand is out there for those boxes, so I would imagine you fill the gap and are a little bit lower in cattle next week. So this is Brad Dennis with BIS Commodities with your wrap-up of the week of January to February 1st.